Well, thank you very much for your kind introduction. And as you said, I returned from the World Bank IMF meetings yesterday. And in the question, how was it, I replied they were boring, which I think is a good reflection of what the world is thinking about the EBRD region of Central and Eastern Europe. Insofar as that the Eurozone was no longer a topic for debate. The emerging market challenges that we have seen during the summer have really left Central and Eastern Europe alone, partially because of the fact that the crisis that we saw in 2009-10, of course, had a significant impact on the region, and the adjustment programs that have been undertaken in Central and Eastern Europe, plus the adjustment programs that have been undertaken in the Eurozone, are beginning to reap their fruits. And so the focus was elsewhere, but even there was not much elsewhere. A lot of attempted discussions about whether or not the US government would default, but I think there was a general consensus that this is a Washington game, but not a game that will have implications worldwide. So it was fantastic because we can focus on business, which is ultimately why we're all there for. It's a real pleasure to be here in Warsaw and to have the opportunity to talk with you about some of the thoughts we have on the growth and the reforms in Central Europe. And you, as CFOs of all the leading companies in the region, will have a crucial role in reshaping economic growth over the coming years. And that's why we thought, and it's important for the EBRD to be here, as you're the companies that we want to support in achieving that. In terms of the opportunities you see, and how policies and regulation can support your strategies, it's important for us to be on top of that and fully understand that, as you're ultimately the ones that need investment, make investment, but also then create growth and employment in your countries. As you will be aware, the bank has markedly increased its investments in Central and Southeastern Europe during the past 5 years since the onset of the crisis, and last year alone we made over 3 billion euros investment in 142 projects in Central Europe. But as you probably have also been confronted by a shrinking capacity of the commercial banks, the increasing regulatory pressures that they are under, has made the environment nevertheless challenging. And so the topic of reforms, I think, is very timely. As you know, across the region, even here in Warsaw, people have been in the streets protesting, and that some of the reforms that are needed to be undertaken are unpopular. And that this spiral of public dissatisfaction, but at the same time the need to reform, are having a slightly negative spiral effect, perhaps least felt in Poland, but very much felt in the other countries of Central Europe. And so the EBRD's growth forecast will be released later this month. But on the whole, the picture is relatively familiar across the region. And that after the decelerating of growth in 2012, it does appear to be bottoming out. We are seeing the Eurozone providing a welcome, but we must really recognize, and I think a colleague from the ECB mentioned this morning, it's still a modest boost, and the underlying micro elements in the economies still remain very weak, although at a macro level we're obviously seeing some signals of stabilization. At the same time, growth of around 2% in Central and Southeast Europe is again the lowest among all the emerging markets globally. Of the 16 economies that we monitor in the region, Slovenia and Croatia have remained in recession this year. Hungary is only slowly emerging for one. And also the sharp slowdown that we saw in Poland in the first half of this year and in Slovakia have also been a wake-up call that vulnerabilities are also there in the countries that have been seen as the most strongest. Overall, the region economic activity has only just gone back beyond the peak that it reached before the crisis in 2008, so that nominally economic activity has effectively stagnated in the past 5 years. But even if we look then at investment, annual investment that's being made, that remains at 18% below the peak. In Hungary, it's even, some countries even worse. In a country like Hungary, the level of annual investment is back to the levels of before the last decade, in 1999. And the aggregate stock of capital is on the whole still decreasing. So it is clear that the dynamism that has attracted many of us in the early years of transition has been partially lost. And some of this may be seen as a hangover from the excesses of the credit boom, in particular in the boom years. And this is something which, in our view, continues to be the case. European banks continue to bring the funding of their subsidiaries more into line with local liabilities. And the process of external bank deleveraging has slowed as risks in the Eurozone has receded, though it has far from over. And so we don't anticipate to see significant growth in the balance sheet of banks over the coming years. Not necessarily in Poland, but in many of the other countries, the lending by banks, both foreign and domestic, is still impeded by very high and increasing stocks of non-performing loans in their balance sheet. And the contraction in fixed investment is, in our view, remains worrying. And this is what provides, ultimately, the technologies, the innovation, the know-how, and the drive of productivity growth that is needed. And I think the lack of that is going to continue to depress growth for years to come. This is obviously in Poland an important issue, as many are looking at ways of having capital formation particularly take place in those industries that are driving higher value added and are focused on innovation and technology. Going forward, it is clear that there is no particular prospect, in our view, of external factors becoming as supportive as they were ahead of in the period prior to 2008. In our view, this period, particularly the excessive high credit growth, was an aberration rather than the norm. Within the Eurozone, the worst of the austerity measures may lie behind us, and growth is staging a very slow comeback, but external trade will not provide the boost to Central Europe that it was in the pre-2008 period, or the immediate period that we in fact saw after this crisis. The institutional reforms in the Eurozone itself will also be slow and hesitant, and to some extent perhaps even incomplete. I mean, progress, for example, in the EU's banking union, although there's lots of positive elements to it, is a case in point. It will be slow, and on the back of that, the behavior of banks will be curtailed. Common disciplines are introduced. There seems to be little willingness at the European level to mutualize risk and thereby break the dangerous feedback loop that continues to exist between banks and sovereigns. And so although we get a banking union, there are many aspects in terms of the resolution regimes, the mechanism to support it, common depository insurance. These issues, I think, will remain elusive for some time to come. And perhaps as a result, strategic investors remain cautious. Large multinational companies sit on large cash reserves worldwide, yet FDI investment in the EBRD region of Central and Eastern Europe remains very modest. Across the countries of operation of the EBRD, the levels of foreign direct investment are much diminished. And in some former star performers, such as Hungary and Slovakia, they currently amount to only 1 to 2% of GDP, substantially below the levels we've seen over the past 2 decades. And although some countries are seeing inflows of more short-term portfolio investment, which has supported some of the local financial markets, and in particular Poland as a relatively liquid market, as well as the exceptional monetary conditions that are in the Eurozone and also in the US, these are aspects that obviously, as we saw, having an impact in particularly on those countries with significant current account deficits, but one can't ignore that they also have an impact across other countries that have been dependent on external capital flows. And so I think that there will be formidable headwinds continue as a result of this weak external environment. And at the same time, the countries in Central and Eastern Europe will continue to face the challenges that are also there in terms of the demographics and the shrinking size of the overall workforce. For many of the countries that we work in, the dividends of past reforms and EU membership are increasingly far less clear to the population at large. And ad hoc interventions we have seen most recently in Hungary, in fact, are gaining popularity. There has been and continues to be a clear benefit to growth from reforms, so why is it so difficult to energize the domestic political class and the electorate? One reason is, of course, that the positive relationship between growth and reforms that we've seen over the past decade in the run-up to the crisis obviously also hold in reverse, and this is precisely what we are seeing currently. As growth slows, the political costs of implementing a reallocation of resources, flexibility in the labor force, these issues are in many ways as difficult to address by the governments as the fiscal headrooms that they're also faced with. But the payoffs from reforms, in our view, can come sooner than many people are prepared to accept. At least that is what the research that we observe from other emerging market countries shows. So gaining a consensus around reforms is more a question of good communication. So for instance, the liberalization of various professions here in Poland has seen a good start in addressing the problems of long-term unemployment. Poland made the biggest advance in the world's business environment indicators last year, and I've no doubt that the gains will show reasonably soon and validate the government's approach. What are the priorities for reforms to revive growth? There is plenty of good advice, not just from us at the EBRD, but of course also from the EU, the OECD, the World Bank and IMF across the region. And as I am addressing the CFO, I want to pick out 4 key challenges in the financial sector in particular that have wider ramifications for growth in the long term. First of all, the burden of non-performing loans in the balance sheets of banks in Central Europe is still a major obstacle to fresh lending. NPLs are high by standards of other emerging markets, and given the current growth stagnation and dearth of credit, are likely to get worse, not better. Experience across Europe has demonstrated that the cleaning of the bank's balance sheets is essential to revive credit markets. There is no universal recipe for doing this, but there are a lot of impediments to hold back proper recognition and workouts. But as we have seen in the US and in the UK in particular, tackling these issues has paid enormous dividends if they've been done early. And the experiences from Asia, and to some extent also now in Europe, are showing how painful a delay in that process has become. We've seen a major shrinkage of long-term credit as banks have become more risk-averse, exactly the type of funding that underpins capital spending, and in particular in sectors such as infrastructure. Banks will always dominate financial markets in Central Europe, Yet, there's a potential to build up local sources of institutional investment that can complement the banking system. Pension funds are very much under pressure, not least here in Poland, but they could be one source of such long-term funding. So, for instance, the bond issues that we've seen in the energy sector in the region have encountered very strong demand, not only from the pension industry, but other long-term investors. And this is something that the EBRD is very keen to help support. It is an initiative that is also now being addressed at the G20, was a significant debate at the IMF meetings through the World Bank and the Global Infrastructure Fund, to find new modalities to provide long-term finance. And similarly, there needs to be a continued focus on further developing local currency financial markets. And Poland is a very good example where Polish zloty money, bond, and equity markets have grown during the past decade. And similar steps need to be taken across Central and Eastern Europe, where most bond and equity markets are far too underdeveloped to support the local economies. And there needs to be a greater willingness to implement regional initiatives, especially in the equity markets. Central and Eastern Europe will never be able to live up to its full potential if it continues to solely rely on the international capital markets for long-term funding. Some countries are responding through a greater role of the state in the credit markets. Hungary has, on one extreme, announced the expansion of interest-free credit facility of central bank for on-lending to SMEs, possibly in an amount up to 9% of GDP over the next 2 years. And here in Poland, but also in Slovakia, the government seeks to establish public investment funds outside of the budget, and thereby hopefully substituting the banks for the capital spending that is needed. Is there a common theme for the needed reforms across the region? Priorities differ, and obviously from country to country. And it's clear that the easy growth based on the convergence with Western European standards of technologies across all sectors have run its course, and new impulse for growth is needed to be found. There's a very real risk of stagnation as modest incomes and with an increasing outdated capital stock. Very soon, Central Europe will need to go to the next stage and foster growth that is based on sustained productivity growth domestically and an increased content of skills and technology based on domestic-based finance. Here, perhaps the Baltic countries over the past years have been pointing the way. Coming out of the most severe crisis by standards of any emerging market during this crisis, they've staged a very impressive and swift recovery. And this momentum is now used to implement 3 very distinct competitive agendas, both in relation to education, skills investment, and investment conditions. The EBRD, for one, is closely involved in supporting the emerging private equity industry, which continues to play a crucial foundation for the more innovative and micro and small enterprise growth. In all the 3 Baltic states, So in terms of this pessimism about growth that I've been talking about, I also went up on a note of optimism. There now may be modest recovery as Western and Central European emerge from a most painful recession since the collapse of the Soviet Union. But there does lie still an enormous amount of potential which the EBRD continues to support. Across the emerging Central European region, we do find economies that are very open. They're supported by an enormous So in terms of this can still be the ambition for Central Europe with its gifted workforce, and many of you here in the leading companies, it is very much within reach. Central Europe is gifted with a very open European economy to the west and a region with enormous natural, human and agricultural resources to the east. And what the countries of Central Europe need to continuously embrace is the value of continuous reform in the state, financial and real economy. And this has been the essence of Poland's success during the past decades, and we look forward to it continuing in the future. I'm happy to take any questions on the EBRD, its strategy, and any of the points I discussed.
Well, thank you, Manfred. Thank you very much. Yeah, as I said, if there's any questions, I think we have a second microphone here. If not, just call out. Yeah, there's a second microphone in the back. To leave you some time, my notes are full of questions. So thank you very much for this inspiring speech where I found a lot of interesting aspects in there. Maybe just to start off, you just mentioned that the relation between